Most people believe markets react to news. Good news pushes prices up. Bad news pushes prices down. That belief feels logical, and it's exactly why it's dangerous. Because markets don't actually fear bad news, they fear imbalances that aren't being talked about yet. Right now, many investors are focused on one thing only: price. They see sharp moves on a screen and assume that price alone tells the full story. When prices fall quickly, the default reaction is simple: something must be wrong with the asset. But price is only the surface layer of a much deeper system. Beneath every chart is a structure made up of supply chains, settlement mechanisms, inventories, leverage, and behavior. And when those underlying structures begin to shift, prices often react after the fact, not before. The most consequential market moves don't start with headlines. They start when something quietly stops behaving the way it used to. Today's environment is a good example of that disconnect. We've just witnessed extreme price volatility in precious metals, the kind that normally signals falling demand or excess supply. Yet at the same time, reports from parts of the physical market suggest a very different dynamic is unfolding. That contradiction is where serious analysis begins. This is not about predicting the next price move. It's about understanding whether the signals investors are watching are still aligned with the reality underneath them. And that's what we're going to walk through, calmly, step by step. During the final week of January, precious metals experienced unusually sharp price movements. Silver fell rapidly from recent highs above the $120 level to below $100 within days. Gold also declined materially from record levels reached earlier in the month, with losses concentrated over a short time window near month end. The speed of these moves was notable, particularly given the relatively stable conditions that preceded them. The timing matters. These declines occurred on the final trading days of both the week and the month, a period typically associated with futures settlement, options expiration, portfolio rebalancing, and position adjustments by large institutional participants. Historically, this window often sees higher volatility across commodities, currencies, and rates. From a market structure perspective, the majority of price movement occurred during U.S. trading hours, when liquidity in futures and derivatives markets is deepest. Outside of those hours, price action was comparatively more stable. This pattern has been observed before during periods of heavy repositioning. Compared to the prior month, the change was significant. January had been one of the strongest months for silver in recent years, with prices rising sharply and sentiment becoming increasingly bullish. The late-month decline therefore represented a meaningful reversal in short-term momentum rather than a gradual trend change. At the same time, several developments were reported in parts of the physical bullion market. Some sovereign mints temporarily paused or limited wholesale distribution of specific silver products due to order backlogs. In other regions, delivery times lengthened and availability narrowed for certain retail formats. These actions were communicated as operational responses to demand and logistics, not as policy changes. It is important to separate these observations. Price movements described above reflect activity in futures, options, and other paper-based markets where contracts are traded in large volume and often settled financially rather than through physical delivery. Availability reports relate to specific products, locations, and distribution channels within the physical market, which operates on a different timeline and infrastructure. No single data point, taken alone, defines the broader market. What is clear is that price volatility increased sharply, momentum shifted quickly, and operational strain was reported in some parts of the physical supply chain during the same period. Those are the facts, without interpretation. Short-term price movements often draw the most attention, but they are rarely the most important part of a market story. What matters more is how those price moves interact with the structure of the market itself. In precious metals, there are two closely linked but distinct layers: the financial trading layer and the physical supply layer. The financial layer includes futures, options, and other derivative instruments. This is where most daily price discovery occurs. Liquidity is high, leverage is common, and the majority of positions are opened and closed without physical settlement. Prices can move quickly in response to positioning, margin requirements, currency movements, or changes in risk appetite. The physical layer moves more slowly. It involves mining output, refining capacity, fabrication, transportation, inventory management, and end-user demand. Adjustments here take weeks or months, not hours. When prices fall sharply in a short period, the first-order effect is financial. Leverage positions are reduced. Margin calls are triggered. Risk models adjust. Funds rebalance exposure. These actions can reinforce momentum regardless of underlying supply conditions. The second-order effects appear later and are less visible. Lower prices can stimulate physical demand from manufacturers, fabricators, and long-term investors who view the decline as a relative value opportunity. At the same time, producers and wholesalers may become less willing to sell inventory aggressively at reduced prices, especially if replacement costs or lead times are uncertain. This can create temporary friction. On one side, futures prices reflect rapid financial repositioning. On the other, parts of the physical market respond more slowly and may tighten rather than loosen, particularly if inventories are already lean or logistics are constrained. Operational responses, such as pausing wholesale orders for certain products, lengthening delivery schedules, or reallocating inventory, are not signals of systemic failure. They are typical adjustments when demand and price move faster than supply chains can recalibrate. Who is affected first? Retail buyers and small wholesalers feel it through availability and premiums. Fabricators feel it through delivery timelines. Producers and refiners feel it through margin pressure and inventory decisions. Institutional traders, by contrast, interact primarily with price and liquidity rather than physical flow. This distinction matters because it explains why price signals and on-the-ground conditions can diverge temporarily without either side being wrong. One reflects short-term financial behavior, the other reflects real-world constraints. Understanding this cause and effect chain helps investors avoid a common mistake, assuming that a sharp price move automatically represents a lasting change in underlying fundamentals. Sometimes it does, sometimes it doesn't. The key is identifying whether the move is structural or positional, and that requires stepping back from the headline price and examining how different parts of the system are responding. That broader perspective is what reduces emotional decision-making and improves long-term outcomes. Periods of sharp price volatility combined with stress in parts of the physical market are not unprecedented. History offers useful perspective, not as a tool for prediction, but as a way to filter emotion and clarify what matters. One relevant comparison is the late 1970s, when silver experienced rapid price advances followed by sudden, violent pullbacks. During that period, financial speculation intensified faster than physical supply could adjust. Price swings were amplified by leverage, thin liquidity during certain trading windows, and regulatory changes that altered trading behavior. What mattered then was not the final outcome, but the sequence. Before prices ultimately peaked, the market went through multiple sharp corrections. Each pullback triggered confusion, skepticism, and premature conclusions about demand. Physical availability tightened intermittently, while paper prices moved erratically. The key lesson is that volatility preceded resolution, not the other way around. Another instructive period is the 2010 to 2011 cycle. Silver rose rapidly, driven by a mix of monetary policy concerns, investment inflows, and speculative positioning. As prices approached their highs, volatility increased, margins were raised, and price discovery became increasingly dominated by derivatives markets. Physical premiums expanded in some regions, even as futures prices corrected sharply. Again, the takeaway is not that prices must repeat those outcomes. What is different today is the structure of demand. Silver now plays a more significant role in industrial applications such as solar energy, electronics, and electrification than it did in earlier decades. At the same time, global supply growth has been relatively constrained, with mine production increasing only modestly over the past several years. What is also different is market transparency and speed. Information travels instantly, positioning changes rapidly, and financial flows can overwhelm price signals in the short term. However, one thing remains consistent across cycles. When financial markets move faster than physical systems can adapt, temporary distortions emerge. History suggests that these distortions do not resolve on a fixed timetable. Sometimes they fade quietly as supply catches up. Other times they persist until prices adjust enough to rebalance incentives. The value of historical context is not to forecast the next price level. It is to recognize that heightened volatility and apparent contradictions are features of transitional phases, not necessarily signs of systemic breakdown. Understanding that distinction allows investors to stay analytical rather than reactive, especially during periods when headlines feel more dramatic than the underlying structural changes justify. Rather than framing markets in terms of certainty, professional analysis works in probabilities. The goal is not to predict a single outcome, but to understand what conditions would need to change for different paths to unfold. Below are three scenarios, not forecasts, based on currently observable dynamics. Each is conditional. Bull case, reacceleration after stabilization. If price volatility begins to compress, and if financial positioning normalizes without sustained liquidation, and if physical demand remains firm at lower price levels, then prices could gradually stabilize and recover. In this scenario, the late January sell-off would be interpreted primarily as a positioning reset rather than a fundamental reversal. Futures markets would absorb excess leverage, allowing price discovery to reflect more balanced participation. Physical demand from industrial users, long-term investors, and inventory restocking would quietly absorb available supply without forcing immediate price spikes. Premiums would remain elevated in some regions, but would stop widening. This outcome would require supportive macro conditions, a stable U.S. dollar, contained real yields, and no sudden tightening in financial conditions. Importantly, this scenario does not assume panic buying or shortages, only steady normalization after volatility. Base case, extended range and adjustment period. If macro uncertainty persists and if financial markets remain sensitive to interest rates and currency moves, and if physical supply chains adjust gradually rather than abruptly, then the most likely outcome is a prolonged period of range-bound trading. In this scenario, prices oscillate within a wide band as markets process conflicting signals. Futures prices reflect shifting expectations around growth, inflation, and monetary policy, while the physical market adapts through premiums, delivery timelines, and product availability rather than through outright price shortages. Volatility remains elevated but less extreme than during the recent sell-off. Both buyers and sellers become more selective. Inventory flows continue, but without dramatic acceleration in either direction. Historically, this type of environment often frustrates short-term traders while rewarding patience and disciplined risk management. It allows structural imbalances, if they exist, to express themselves gradually rather than explosively. From a probabilistic standpoint, this is often the highest likelihood scenario following sharp but isolated volatility events. Bear case, structural shift in demand or liquidity. If real yields rise meaningfully, or if the U.S. dollar strengthens persistently, or if industrial demand weakens due to economic slowdown, then prices could continue to face downward pressure. In this scenario, the late January move would mark the beginning of a broader reassessment of demand expectations. Financial markets would price in slower growth or tighter monetary conditions, reducing the appeal of non-yielding assets. Physical demand might remain present but insufficient to offset broader macro headwinds. Premiums could compress as buyers become more price-sensitive, and availability would improve as inventory turnover slows. This outcome would not require market dysfunction, only a change in macro assumptions. Importantly, even in this case, price weakness would be driven by external variables rather than internal failure of the silver market itself. Why this framework matters. Notice that none of these scenarios rely on certainty. Each depends on conditions, not convictions. Markets rarely move in straight lines, and dramatic short-term price action often exaggerates perceived risk. By mapping scenarios rather than narratives, investors can evaluate new data as it arrives without anchoring to fear or optimism. Probability-based thinking doesn't eliminate uncertainty, it manages it. When markets become volatile, the most valuable discipline is filtering noise from signal. Rather than reacting to headlines or social media narratives, I focus on a small set of indicators that historically influence precious metals over intermediate time horizons. U.S. dollar index, DXY, movements in the dollar remain one of the strongest external drivers of gold and silver prices. Sustained dollar strength tends to pressure metals, while periods of consolidation or reversal often relieve that pressure. What matters here is not daily fluctuations, but trend persistence and breadth. Treasury yields and real rates changes in nominal yields, particularly on the 10-year Treasury, affect opportunity cost. More important, however, are real yields. Rising real rates historically weigh on non-yielding assets, while stable or declining real rates tend to support them. I'm watching whether recent yield movements are driven by inflation expectations or growth assumptions. Inflation data, CPI and PCE. Inflation prints shape monetary policy expectations. Unexpected upside surprises can reintroduce hedging demand, while downside surprises may reinforce rate stability. I'm less focused on the headline number and more on trend consistency across multiple releases. Volume and liquidity in futures markets. During volatile periods, volume patterns reveal whether moves are driven by forced liquidation or discretionary positioning. Stabilizing price action accompanied by declining volume often signals that the bulk of repositioning has already occurred. Open interest in positioning changes. In open interest help distinguish between short covering, long liquidation, and new directional bets. Persistent declines in open interest during falling prices suggest leverage is being reduced rather than new bearish conviction being established. Physical market signals, secondary. While futures markets set price, physical indicators such as delivery times, premiums, and inventory commentary provide context. These signals are slower moving and region-specific, but they help confirm whether financial price moves are translating into real-world behavior. Together, these indicators form a framework rather than a prediction. No single data point is decisive. The goal is to observe alignment, or lack thereof, across financial, macro, and physical dimensions. That alignment over time is what ultimately determines direction. Periods like this tend to test discipline more than analysis. Sharp price movements naturally draw attention, but they rarely provide the full picture on their own. Markets are complex systems, and short-term volatility often reflects positioning, liquidity, and timing rather than lasting changes in underlying value. What matters most is maintaining perspective. Risk is best managed not by reacting to each price swing, but by understanding the forces that shape those swings over time. That means separating financial market behavior from physical supply dynamics, recognizing the role of macro conditions, and accepting that uncertainty is a constant, not a failure. There is no need to rush to conclusions. There is no need to force conviction. This isn't investment advice. It's simply how I'm reading the market right now. Patience, position sizing, and a clear process matter more than being right in any single moment. Over full cycles, those are the traits that tend to compound, quietly and consistently. If conditions change, the framework changes with them. That's how disciplined analysis works.